Hello everyone. Today on the Final Bar, I'm talking with Joe Rabil of Rabil Stock Research. We'll see an area of the market where he is seeing strength despite a lot of warning signs. We'll talk about continued references to narrow leadership, Alphabet, certain names like that doing fine, others struggling. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was started about 24 years ago as a way to empower online individual investors to better understand the markets. Now we have individual investors, financial advisors, institutional investors, many others using our platform to try to make sense of these markets. And what's really interesting is you can use an analysis of equity indexes, of breadth and sentiment conditions, of ratio analysis to look at offense versus defense, small versus large, but you can also go into other asset classes as well. And I think now more than ever, you have to think about the interplay between equities and bonds, between commodities and currencies, and how all of these things relate. Well, today on the show, we're going to try to dig into some of those themes. We have a great guest today, by the way, Joe Rabil, who's an incredibly talented stock picker and also has a really good sense of things with some longer term charts that maybe will help us think a little bit and put things into proper context. Before we get to that though, let's get to our market recap and see what actually happened today. Using StockCharts, first off, the S&P 500 finishing up about 1/3%. It really ended up being sort of a weaker morning, sort of stronger midday, sort of consolidating afternoon. You had that big meal in the middle of the day, a big lunch for the markets, and then we're sort of digesting it here in the afternoon, finishing near the highs of the day around 41.05, which is encouraging, but again, still up only about 1/3% from yesterday's close. We're sort of continuing that choppy environment. And to be honest with you, this sort of environment, generally choppy, no huge directional push, lighter volume is pretty much the standard playbook for right before a long holiday weekend, which is what we're getting with, again, tomorrow, the Good Friday holiday. Markets are closed back on Monday. The NASDAQ composite up about 0.75% to 12,090. And you can see the NASDAQ 100 up about the same amount as well. Mid caps and small caps essentially flat to a little bit down. The relative performance of small caps, as I was talking with Joe Rabil before the show today, and with a number of my guests recently, we've talked about this issue, right? Where small caps are not looking nearly as strong as other parts of the market. The general sense, the general takeaway from that is that's sort of a risk-off vibe. That's not really a risk-on things are great vibe. That's more of a we're getting defensive. Also, things like utilities and REITs being in the top 3 sectors of the day always puts a bit of a question mark on my list as well. Let's look at the other asset classes here quickly and see what we can see. Looking at interest rates, we can see a bit of a mixed bag actually. The long bonds coming down a little bit on a yield basis. The shorter end of the curve, even up to the 10-year yield, sort of up to sort of flat for the day. Bond prices up about 0.25%. The dollar index essentially flat from where we were yesterday. Looking at commodities here really quick, you can see the DBC, which is a broad commodity ETF, down about 1/3%. Gold and silver down, but again, not by much. Copper and oil prices a little bit to the upside. No significant movements to speak of, to be honest. Sort of a quieter day on average. Cryptocurrencies, again, sort of a mixed bag. No huge moves, and in an area of the market where you tend to think of higher volatility and big percentage swings, definitely a quieter day of sorts. Bitcoin holding above 28,000. That level is one we've talked about. Getting above 28,000 is interesting. Staying above 28,000 is what's so key. And if we look at the little preview chart here, looking at Bitcoin, we can see we're chopping around here in the last 24 hours or so. The real question for Bitcoin is, can it get above 30,000, right? That's the big move, right? That's the big round number. Ethereum, can we get up to 2,000 and not just get there, but power higher? Those are the types of questions I would be thinking about to see what we can see. let's look at a daily chart of the S&P 500, sort of see how this day fits into the overall trend. We're looking at the S&P chart. You can see the, again, sort of range-bound feel over the last 3 months, right? Just look at the last 3 to 4 months. Start the clock maybe December of last year and look to where we're at now. Now, my first observation is we're about the same place we were in December of last year. Up to the penny, we're almost at the same place. So with all the movement, even with a mini financial crisis, with year end, with the Santa Claus rally, all of those things combined, we haven't gone anywhere directionally, right? We're at the same place. Now, having said that, there are a lot of, at times career-busting moves between 2 points. So we then have to think about this overall range. And again, as we've talked about with these shaded areas, 3,800, a clear level of support. And I was taught once is chance, twice is coincidence, 3 times is a pattern. So the more that you test a level of support, just like the more you test a trend line, the more that it validates the importance of that level, the importance of that trend to a particular chart that you're looking at. So the fact that 3,800 continues to serve as support every time we do that, it just more and more reinforces the importance of that 3,800 level. So if we would sell off from here in the month of April, which again would definitely be against the average trend for the month of April, which actually tends to be pretty strong for the S&P 500. If we would go lower, clear support about 300 points below current levels around 3,800. Now, the question really for the markets here is, can we hold 4,100 to the upside? The way that I would interpret the market really since November is November was that big push off of the October lows. This is when we retested this big, thick green trend line coming down off of the 2022 highs, and then we came lower after 2 tests actually over about a 2-week period. We then finally powered above there and broke above the trend line. It broke above 4,100. And I remember right in early February doing the show at this time, things actually felt pretty encouraging, right? A lot of individual stocks were actually making new swing highs. It was hard to not get pretty interested in the upside potential for stocks. And you're starting to look at the August highs, maybe even longer term highs, 4,800. What would it look like if the market keeps going higher? But February was a very different market. The dollar was stronger after being weaker in January. Risk assets all came down. And I would see this February high as an unsuccessful retest or an unsuccessful attempt to really follow through to the upside, right? We got above there for about a day or two, and then that was it. We sort of fizzled out and retested the low. So once again, we are testing this resistance. And once again, I would say a strong market doesn't just go to resistance, it goes through resistance, it goes further to the upside because additional buyers, basically anecdotally, additional buyers come in and are willing to pay more and more, which pushes price higher, that additional demand. Still a question mark, I would say, overall, but looking at a lot of individual names, they're not testing their previous highs, right? The big mega cap names certainly are in select groups, but overall, I think, again, a big question mark going into the holiday weekend, and certainly a question that maybe we'll be able to answer next week as we sort of get back to normal on Monday and see what comes after that. Looking back at the dashboard, let's check in on the 10 S&P sectors. We can see communication services actually up the most today, up 1.3%. Decent updates, handily outperforming the benchmarks. Second and third are utilities and real estate, both up about 0.7%. And again, what's noteworthy there is that these are fairly defensive sectors, right? So when the market moving a little bit higher, but when it's driven by more defense than offense, again, utilities can do very well in a bull market. It's unusual, but it certainly has happened. And a great example of that is 2014. If you look back there, these two sectors, utilities and real estate, were actually the top 2 sectors in the S&P for that year, which was a positive year for stocks. But it was some defensive leadership that actually pushed higher. Now, different world there than where we're at now, about 9 years ago. However, it has happened. So there is a bit of a precedent for that. But generally speaking, if the market's healthy, if the market's strong and going higher and people are taking on additional risk, I would expect riskier sectors, maybe more growth-oriented sectors, more higher beta sectors doing better than what we're seeing. At the bottom, we have 3 what we call the MEI sectors: materials, energy, and industrials. Energy actually giving back the most today, down about 1.5%. So it's a great reminder on a day like today, something like communications up about 1.25%, energy down 1.5%. Even in a sort of choppy sideways day, there's often differentiation when you look at some of the individual stocks and themes that make up this market. Just to finish off our recap, looking at a couple individual charts, maybe some breadth analysis as well. When you talk about the strength in this market, you have to think about some of those mega cap FANG stocks, or what I call the phenomena stocks, those 8 names that represent the big mega cap sort of growth trade. Alphabet making a new swing high today, getting above 108, closing around 108.40. That's about 3.8%. So a nice update. Sort of a mini, maybe cup and handle pattern. It's not really the classic cup and handle. It's a little too short term to call it that. So I don't know if I want to necessarily give that label, but you certainly have had this rounded bottoming pattern bounce off of 90. Essentially retesting the previous high around 107, pulling back to the 200-day, and you definitely would say that this has been a failure at the 200-day in February, breaking above the 200-day in mid-March, retesting from above, and so far actually resolving to the upside. So overall, strong chart, right? And actually a chart that's showing I would argue, a clear transition from a distribution phase for most of 2022 to essentially an accumulation phase in 2023 with additional demand, people willing to pay more and more for that particular stock. Now, this is not a one stock market, so of course we have to look at measures of breadth and think about different conditions and what they represent. Let's start by looking at the advanced decline lines and see where they are at. To be honest with you, kind of mixed, to be honest. This is the 4 advanced decline lines. This is for the New York Stock Exchange for large caps, mid caps, and small caps. You can see really only one of the 4, the S&P's AD line, is remaining above its 50-day moving average. The other 4, with mid-cap moving lower today, are actually back below their 50-day moving average. When we talk about the difference between large and small caps, look at the breadth on the small cap chart, right? Ignore the other ones and just look at this bottom panel, and you can see how this is sort of a distributive pattern from the February peak to where we're at now. We're sort of making lower lows and lower highs. And that's why the market does not feel as great as the major benchmarks might imply, with the fact that the S&P is kind of right at 4,100 and potentially breaking out. It's because the breadth, as you get smaller and smaller, is actually looking less and less attractive. So if you have a portfolio of a bunch of stocks with a bunch of different market caps, some of them probably not looking nearly as good as charts like Alphabet and Meta. I do want to point out on something like the bullish percent index on the McClellan oscillator, these are not horribly negative signals, right? The bullish percent index on the S&P 500 is over 50%, which means over half of the S&P members are in a bullish point and figure chart. Here's the challenge, though. That tends to be a bit of a lagging indicator, and they're recognizing the rally off of the lows in mid-March. The question is there enough follow-through? And what I would argue, if you're bullish here, is you need to see these breadth conditions not pulling back, but actually pushing higher. You need to see the McClellan oscillator remain above 0, which it is for now. You need to see the bullish percent index remain above 50%, which it is for now. But if we would roll over going into next week, those could be some of the signs that there's deterioration under the hood that's really going to start to weigh on the major benchmarks like the S&P and the NASDAQ. Let's take a quick commercial break. We'll be back with Joe Rabil in just a moment. See you then. Hey everyone, welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. It is a pleasure to put the show on for you every day. We've got a great team helping us do so. We've got a lot of good plans for this studio and for StockCharts TV in the coming weeks and months. So we're excited to go on this journey with you. A couple quick announcements before we bring on today's guest, Joe Rabil. First off, we welcome your questions. Really appreciate you sharing some of the things you're running into as you are analyzing your own charts using the StockCharts platform. Our email is the best way to get a hold of us, thefinalbar@StockCharts.com. We're also on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our StockCharts YouTube channel. We'd love to hear from you. We'll do another mailbag segment on Monday of next week. We'd love to feature your question live on the air. Speaking of what's coming up, we have the market holiday tomorrow, so we will not be doing a live show. However, I asked a couple of my StockCharts TV friends, Julius DeKempeter of RRG Research and Greg Schnell of Osprey Strategic, to share how they use multiple timeframes in their analysis. I shared some charts that I use as well on our ACP platform. It's a really good episode talking about some different ways to think about a particular asset, a particular chart on multiple timeframes. So make sure you check that out. Coming up next Monday on April 10th, we have our next episode with the Final Bar Mailbag. We have a number of guests coming up later in the month, starting next week. Chris Shavako of Shavako Capital, Miss Schneider, Ari Wald, and many, many more. So make sure you tune in to our live broadcast, 4 p.m. Eastern. I want to welcome on today's guest, Joe Rabil. Joe's the founder of Rabil Stock Research, host of Stock Talk with Joe Rabil on StockCharts TV, also the author of a pretty decent book about multiple timeframes, if I remember right. Joe, good to see you. Welcome back to the show.
Good to see you too, Dave.
So I was watching one of your previous episodes here just from this week on StockCharts TV, where you're taking Q&A from some of the viewers, and you were looking at a lot of different names. And again, I always appreciate the way that you think about charting using indicators like the MACD, like the ADX line. So I'm really excited to go through some of the broader things, and then we'll get a little more fine. Starting with gold, right? Talk about an area of the market that's actually showing strength at a time when others are not. Gold's kind of it. We're looking at your chart with the quarterly on the left, the monthly on the right. Can you talk us through what you're seeing here?
Yeah, I mean, it was a perfect lead in what you were talking about before about the multiple time frames, because I'm a big proponent of that, obviously, in the way that I do my show and everything that I look at. So normally what I do is I start with a monthly and I work down. I like to help guys with their timing and lowering risk by going down to the smaller time frames. But in this instance, I thought it was worthwhile to actually go up, because you know, the markets are fractal and we can go up in time frames. And we've got a quarterly chart here on the left I wanted to focus in on to start. And look at what's taken place here. We got this really strong move that blew away to the upside into 2021, right around 2020. And it's been consolidating back towards the 18 on that quarterly MA there, right? So bounced off that line and has shown a lot of strength. When you go down and look at the ADX, it's in a really powerful position, crossed over the 25 line and is hanging in around 40. So it's just funny. I mean, I look for this exact pattern on a daily chart or a weekly chart, and this is showing up on the quarterly here. Now, we have to take that into account when we're looking at this. So it's not like it's a timely situation from a quarterly standpoint. So we go down to the monthly. One of the things I really loved about this pattern is how it undercut that 160 level, that key support, and then just took off and then rallied up to 180. And then you see the red monthly bar down that tested the moving average environment and then has turned up again. These are the types of things that I think are really constructive. That's very bullish price action. And then the other thing I wanted to point out is when you look at the MACD, look at how it was way overbought in 2020, extended away from the zero line. And now it's worked all the way back down and bounced off that zero line and is turning up. So, I mean, these are really constructive supporting evidence that in the bigger picture, there's some really good things that are coming in this. I'm not saying it's a buy today. I'd actually like to see it consolidate a little bit, but you want to think ahead like you're a chess player. You want to think 3 or 4 moves in advance. And I think this is something we want to be on the lookout for, looking at the individual names over the next month or two for entries.
There's a quote in there somewhere. I love what you just said. You know, trade like a poker player, invest like a chess player. There might be something. We'll work on that together, maybe, Joe. But I love that way of thinking about it. You're right. You have to think a couple steps ahead. And again, buy signal from the MACD on the monthly chart just recently. I have to ask about the dollar, of course, right? When you think about gold and what's maybe been preventing gold from being as resilient, the dollar being so strong was really weighing on the price of gold. What are you seeing now when you're looking at the chart of the dollar? What does that tell us about the conditions here now?
I mean, to me, this is supporting evidence into what I'm seeing on the gold chart, because it was acting like an anvil to gold. I mean, gold can't really go up with this thing skyrocketing to the upside. But now look at the reversal in this pattern. This is not, to me, it doesn't mean it's going down because there's a massive amount of support underneath. But is it really going to repeat what just happened? I don't think so. I think the odds are we're going to form some kind of a trading range. And it's possible we could leak down towards 100 or something like that and maybe create a range between 100 and 105 or 7 or something like that. But the upward pressure on this, I think, is kind of gone. And I think that really helps out the gold chart. I think it's a great supporting evidence for that.
Yeah, you mentioned before sort of this V top that we see on both the monthly chart and the weekly chart, really a stark contrast from what we saw for much of 2022 to what we've seen really in the last 4 to 6 months. Now, you brought a couple individual stocks, I think, in the gold space or in the material space to think through. We're starting with FNV Franco-Nevada. What's the idea here?
So this one has the monthly on the left and a weekly on the right. So look at the monthly on the left. And again, let's focus in on the indicators. I'm an indicator guy. Might as well talk about the indicators. So in 2020, this made a peak, a really strong move, though. It went up from 75 to whatever that peak was. And look at what the MACD did. Really strong move, but it got really stretched away from the zero line, right? Now, the ADX crossed above and confirmed that peak with a strong move up to about 35. And to me, that's very bullish when you get a strong move that's confirmed by ADX. Now we've been correcting, and you can see it in the MACD. It's finally worked its way back down to the zero line. It's starting to cup around, turn around. So to me, this looks like a long consolidation phase on a monthly chart. And now we're starting to get, again, another undercut and rally pattern on the weekly where we undercut that key low around 125, get a strong move up, test it, and then turn back to the upside. I mean, again, these are bullish patterns, bullish things that I think are taking place here.
And the weekly chart as well, really showing some of the choppiness, but really rotating higher in the last, I guess, in the last 6 months or so, right?
Yeah, and I mean, I don't want to sit here and ignore all the resistance at 160, 165, but the way it's coming at it, the way it had the undercut, the way it tests that low, the way it's turning, and the way I know what's going on in the bigger picture, I'm of the opinion that we're going to kind of work our way through that resistance over the next 3 to 6 months.
I always feel like I can get away without looking at technical indicators, and then I talk to you, Joe, and then I make notes to add them right back to my chart. So thank you for making a legitimate case for looking at things like the ADX and the MACD, as always. The last one you brought with you is OR, a little smaller name than that some may be less familiar with. What's the idea here?
Well, I mean, if all stocks look like this, we'd be as bullish as could be. Right? I mean, look at this monthly pattern. This is the classic base breakout, and look at the ADX. The ADX has been low since 2016, and now look at how the green DI, that's the strength of the buyers on the monthly chart, are breaking out for the first time in years, and that's causing that blue line, the ADX, to turn up. The volume pattern's good, especially when you look at the weekly. Look at the volume has been above average for the last 4 or 5 weeks in a row now. Yeah. So there's just a lot of little things going on here. Obviously, a little overbought in the short term. It looked for a little pullback towards the breakout area, but man, I think this is pretty impressive.
Now, you know, obviously we're focusing on an area of the market that's actually showing some strength. Other areas of the market struggling a little bit. You know, when we talk about narrow leadership, that's been a topic that's come up a number of times recently, right? If you take Alphabet and Meta and those out of the picture, the market probably looks a little less constructive. In your opinion, right, is it a bad thing that the market's going up driven by some of these big mega cap names? Why is that, or is that not a concern from your perspective, big picture?
I mean, my biggest concern is that a lot of these look like trading patterns to me. They don't look. So this is a great example. So yes, there's constructive action taking place. On the weekly chart, it broke the downtrend line. It came back and tested that 90 area, turned back up. But when we go and look at the monthly chart, what we're really doing is rallying back up to a declining 18-month line. This trend kind of rolled over, and we're rallying back into resistance. So again, I love to use multiple time frames for this. Now, a stock like Microsoft or Apple, they're a little bit stronger. They could carry a little bit higher, but I still would put them more in a trading. They're more like trading plays to me rather than the start of some significant trending move. I don't think these are starting another trend right now. They just went. I use the analogy like they just ran a marathon, and they're like in the tent, you know, afterwards getting massages and stuff. They need to go through a little bit of a rest here before they're ready for another marathon. I don't think they're ready for that. They need to go through a longer period of mending.
I think, you know, and I think, Joe, a lot of times it comes down to a multiple time frame sort of question, right? If you focus at the last month, things feel incredibly strong, resilient, coming off the lows. But when we're looking at the monthly and the weekly chart, really puts it into perspective, right? In the monthly chart of Alphabet is a great example, right? Rallying into this declining long-term moving average. So with that in mind, then, what would you need to see either from the S&P or from some of the names like that we've looked at that would maybe tell you that the conditions are improving? Is it the S&P getting above 4,100 and powering through and staying above there? Or is there some other signal using indicators maybe we've talked about that would give you sort of an all clear risk on things are great at this point?
Well, it's going to be stock by stock, I think. Yeah. But what I look for is momentum is going to kick in. I take immediate momentum over resistance. So if I have a daily chart showing strong momentum, like in something like Microsoft or Apple or whatever, then I'm not necessarily going to sell the moment it hits that declining moving average, that 18-month. I'm going to give it a chance to break through. And then if it spills over into the weekly and the momentum continues to improve, then we could be in for something a lot more important. So if the momentum is bad going into that 18-month, I'm probably just a seller. It's just, it really just kind of depends on that. That's how I handle that. It's just, I don't think you can assume it's going to fail there. But if there's no momentum, then you can probably be rest assured that it's going to really struggle.
Joe, this was fantastic. I really appreciate you sharing big picture to small picture, but really focusing on some of the long-term charts and making our ACP platform sing as always. Great to see you. Be well, and we'll talk to you again soon.
Great to see you too, Dave.
That's Joe Rabil. Joe's the founder of Rabil Stock Research, coming to us from the Washington, D.C. area. He's also the host of Stock Talk with Joe Rabil on StockCharts TV. He runs every Thursday, 2 p.m. Eastern. I mentioned his book, by the way. It's called Invest Like a Pro, Using Technical Analysis in Multiple Time Frames. It is really, really well done. I have it on my bookshelf. I'd encourage you to check it out. It really helps think about this value of looking at multiple time frames. And I told Joe before we went live, I was watching his show from last week, and I'm going to borrow with crediting him his ACP view with 5 charts. Is really well done. If you missed it, check out his show. You'll see what I'm talking about. We need to wrap the show though, folks, and go to the 3 in 3. Let's talk about 3 charts in 30 minutes that tell the story of this market environment. Here's chart number 1. When we talk about the market currently and what's happening, right, I have to focus on the FANG stocks, or what I call the phenomena stocks, those 8 mega cap technology, consumer discretionary communication services names that are doing so well. And I guess another one of the ways to think about this market is that it is narrow leadership. And I think that's totally valid, right? How bullish do you want to be if it's just a relatively small number of companies that are doing well? But to flip that to the other side, I guess the other side of that argument is, how bearish do you want to be if Alphabet is breaking above its 200-day moving average and staying there? How bearish do you want to be if Microsoft and Apple are doing well? The problem with that being bearish in that environment is they have so much market cap. They represent so much weight in those indexes that if they're holding up, the indexes themselves are going to do pretty well also. That's why I think paying attention not just to the S&P, to the Qs or the NASDAQ charts are important, but also looking at some of these key names to see if you find signs of weakness. Today, Alphabet making a new high for the year, getting above 108. Can it hold that, right? And can it remain above the 200-day moving average? I think that's the most important question for all of those charts that I just mentioned. Chart number 2, let's talk about volatility. We haven't talked too much about the VIX recently. I was thinking about my conversation with Katie Stockton the last time she was on the show. We dug in a little bit to the VIX on a shorter term time frame, thought about that relationship. You think about the range-bound environment that we see right now with the S&P 500, sort of ranging between 3,800 on the lower end, 41 to 4,200 on the upper end, with all of the upswings and downswings, with all of the different narratives, with the Fed, with the banking crisis, we're still just firmly within that range. The VIX, to be honest, has also been fairly range-bound for over a year, almost a year and a half now. Go back to November of 2021, really into January of 22, and you can see we fluctuated from around 18 to 19 on the lower end and 30, we'll call it to 35 on the upper end. This is not the most perfect trading system in the world, and it's certainly not the way that I would think of it, but look at what's happened with the VIX. This spike in the VIX is that the financial crisis, or the mini banking crisis, whatever we're going to call it, that happened in the month of March. Again, I think the jury's still out as to whether or not we are done feeling the ripple effects of that. I would argue that we'll probably still be hearing about things related to that here in the coming months. But for now, the volatility has settled right back down to pre-banking crisis levels. And I think the bullish case for stocks probably involves the VIX remaining fairly low, probably below this purple shaded area around 20 or 21. We start spiking above there on a sell-off, and I think that's a little bit more uncertain. That's what happened in mid-March, which is why it was a potential disruption in the market. Limited impact overall as the S&P remains fairly elevated. Finally, our third chart. Wanted to point out the fact that the AAII survey, which is updated basically every Thursday, we look at this week's ranking, big jump higher in bulls from about 22% to 33%, big drop in bears, still around 35%, but it's almost a 1-to-1 ratio. And you can see at the bottom the spread between the two. The AAII survey has been net positive only 3 times in the last year and a half. Every one of those times have been short-term tops. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for our show, The Final Bar. Special thank you to Joe Rabil of Rabil Stock Research, joining us from Fairfax, Virginia. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.